So I think it is becoming pretty clear that as of mid-2022, we are entering in a period of stagflation. Usually that implies that people are having doubts about the currency. Stagflation is a test of the trust people have in that currency. And usually that comes from a period of very large deficits and uncertainty about the future. We are in a stagflationary period, which means the growth is low. And the Fed has to choose on trying to increase growth somehow or trying to reduce inflation. The last time we had a period like this was in the 70s. 1971, the United States abandoned the gold standard, and that caused a lot of uncertainty in financial markets. And it pretty much led to a decade-long stagflation, which had to be ended in 1982 with Federal Chairman Volcker raising interest rates as high as 20%. And he had to raise them that high because it was a matter of reestablishing the trust. And the Fed had to be there and basically say, we do whatever it takes to make the dollar strong again. That's the period which, we are heading towards. I'm very doubtful that we can go to a 20% interest rate because if back then homes were a lot cheaper than they are today, and if you own a home which is a $300,000 home and you're paying 20% interest, well, that's $60,000 per year in interest. And most people, that's a whole salary, and people have to eat as well somehow. So it will be interesting to see where that balance is going to be stricken. And I think the Federal Reserve has a big conundrum now because as you increase the interest, you're increasing the amount of money the government has to pay on this interest. And usually the only way of paying for it is to essentially create more currency. So it goes into this spiral. And as the only way out of that, probably the best bet is to increase interest rate very quickly, shock the market, and hope that people are going to sort of accept the US dollar as being the valued currency and the reserve currency for the time being. And, that is sort of the hope. But is that enough, to convince people? We will see. Inflation is very much a psychological factor, but it always comes following a large amount of currency creation and very large deficits. So as we are looking back over the last 40 years, the United States has printed more and more money and has then come up with economic theories why printing money is a positive thing and we should no longer be worrying about debt, modern monetary theory. So we're now giving our politicians an excuse to spend more money. And instead of restraining them, we are somehow condoning that, which led us to a point where in 2021, the United States had a deficit of about $2.8 trillion. And to put that into context, it took the United States almost 200 years to accumulate the first $400 billion, which is where we were back in 1971. And by 2021, it took them just 50 days to get $400 million in additional debt. So the rate of debt increase went up by a factor of 1,400 times. What can go wrong? Something has to give. There has to be a day of reckoning. And that day of reckoning is always going to come with people starting to doubt the currency. It's a natural phenomenon throughout history that has happened every time. And it starts with lower inflation, that inflation will go higher. The printed money in the early part of this decade went into stock markets, pushed the stock markets up. And we had this dichotomy of stocks going up and the real economy not being there. But as we're heading towards stagflation, that is going to change because during a stagflation, if equities are not going to do well, revenue is going to go down because growth is slow and we're essentially going into a recession. At the same time, with inflation going higher, interest rates are going higher, which means that both your input costs, your operational costs, and your financing costs are all going higher. And that's going to squeeze profits. So stocks are going to do badly, as what we are seeing right now. Bonds are going to do badly because inflation by mid 2022 is around 9.1%. But yet your typical bond will probably pay in the order of 3 or 4% maximum, which means that you're guaranteed loss of 5%. If you're holding cash, of course, you're in the worst of all scenarios, because while you've got some liquidity, you essentially are bearing the brunt of the purchasing power loss, which the government itself is telling us losing 9.1%. So it makes a lot of sense to put your liquidity into another liquid asset like gold, which tends to appreciate during a period like this. And if you look at the 1970s, that appreciation during that decade was an average of 19%. Because in 1970s, we started with around $35 gold. And by the early 80s, we ended up with 800. So gold went up by about 22, 23 times in that decade. Silver started with $1.50, and it ended up around $50 or close to it. So we're talking about appreciation of about 30 to 35 times. Is it going to repeat like that? Well, it's going to rhyme, certainly. And at the beginning of a stagflation, everything might be going down, and what we're witnessing right now is gold and silver actually falling somewhat. And that's quite common because people have to sell whatever they get their hands on. You can't really go wrong by buying some gold and silver because the performance of the last 50 years has been average return of 7.8% for gold and doing a stagflation of about 19%. At the same time, I would like to point out that at the beginning, or nowadays, it is estimated that about 0.5% of total US wealth is actually in precious metals, whether physical or paper. And during a stagflation, more and more people are rediscovering these metals. And as that money flows into the metals, that percentage goes up. By the end of the stagflation of the 70s, that percentage went up to between 6 to 8%. So I don't see any reason why this time should be different. So I think it's reasonable to expect that we will be seeing an increase of 12 to 15 times more wealth flying into precious metals. And so the combination of a quickly, fast depreciating currency and of more demand into precious metals, especially physical precious metals, I think is really going to push that up. And as a caveat, these things take time. These are not predictions for next month. But over the years, we'll definitely see that, I believe. By the end of the decade, you will see gold and silver at much, much, much higher levels. And I think it's a fair comparison to compare it with the 1970s. So from a precious metal point of view, precious metal tend to do very, very well during periods of high inflation and money printing. If you look at the last 50 years, most of the gains in gold have been between 1971 and 1981. During that decade of stagflation, gold went up on average of 19% per year, and it ended up at about 30 times the price of 1971. And then we had a period, until 2008, where really gold wasn't very exciting. But once the financial crisis happened and quantitative easing started going loose, monetary policies, people started moving into precious metals because of the lack of counterparty risk. And that's when we saw the new increase in prices and of gold and silver. And now we are sort of at the end of that in a world where we've never had so much debt, we never had so many deficits, and we're now entering a stagflation period, which is a period when gold and silver does best. So based on that, we are going to see gold and silver play an extremely important role this decade, much, much more than we did over the last 40 years. And we're going to see many, many more people buying precious metals. You should not start buying gold futures and put 90% leverage because we're going into a recession. You should buy gold and silver. My way of doing it is to own the physical. You put it under your bed and you just wait. And you will be able to sleep well, because at the end of the day, when the dust settles, gold and silver is going to fulfill that role, just as it did over and over and over history.